Howdy, everybody. Welcome to Liberty Call. Today is, what day is this? Thursday, September 19th, 2024. Hope you're having a great day out there. It is a beautiful day here. A little chilly this morning, but it is amazing. I mean, there's not a cloud outside. It is cool. It is wonderful. Still can wear shorts, but, it's no hot at all. Anyways, hope you're having a great day. God, my beard's a mess. I just worked out and recombed it, and it's a mess already. So if it is your first time watching Liberty Call, if you could do me a favor before we jump into the news, if you could give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. All right, markets were in a good mood today. I'm not sure why, but nothing's really changed other than the interest rates are down 0.5%. But starting out, Dow Jones up 1.26%, 522 points, closed at 42,025. S&P 500 up 1.7%, 95 points, closed at 5713. NASDAQ up 2.49%, 438 points, closed at 18,011. The VIX was down 10.42% to date at 1633. Canada was up 1.16%, Brazil down 0.34%, and Mexico up 0.54%. Over in Europe, Germany was up 1.55%, the UK up 0.91%, France up 2.29%, the Netherlands up 1.77%, Spain up 0.8%, Italy up 1.16%, Switzerland up 0.69%, and Portugal, the lone bad spot, down 0.51%. Russian exchanges split today. The MOEX up 0.47%, our TSI down 0.64%. And the overnights, the Nikkei in Japan was up 2.15%, Australia up 0.61%, New Zealand up 0.76%. In China, the Shanghai was up 0.69%, the Shenzhen Component up 1.19%, China A50 up 0.42%, DJ Shanghai up 0.99%, Hang Seng up 2% even, and the Taiwan weighted down 0.78% when it closed on the 8th or 18th. All right, so that is that. Get over to our market recap and see what happened today. SP 500 closes above 5,700 for the first time ever as tech glows. Yeah, because tech loves lower interest rates because that makes their future valuations much higher, which doesn't really change anything other than, well, this is what we speculate your future value of your security is going to be. But it makes borrowing money a lot easier too. All right, let's get into it. Where's my notes? The SP 500 reached a fresh all-time high on Thursday, gaining 1.8%, led by a surge in tech stocks following the Federal Reserve's decision to begin an easing cycle with a 50 basis point rate cut. The Dow Jones Industrial Average rose 528 points. The NASDAQ climbed 2.8%, driven by gains in major tech companies like Meta, Apple, and Tesla. Chip makers, including NVIDIA and Intel, also rallied, with Intel stating it has no plans to sell its majority stake in Mobileye. The rate cut, which lowered the benchmark rate to 4.75 to 5%, has sparked optimism about a soft landing for the economy. Sure, if you believe that. The Fed indicated that 2 more 25 basis point cuts could follow this year, though markets are anticipating more aggressive rate reductions. I guess if you think the market's going to go to crap and they're going to cut rates, as close to zero as they can to try and help us, and that's in quotes for those of y'all who are listening. Citi expects another 50 basis points in cuts in November, but others like Jefferies predict a smaller 25 basis point cut contingent on labor market data. Initial jobless claims for the week ending September 14th came in lower than expected at 219,000, suggesting a moderate slowdown in the labor market, which could influence the Fed's next move. In corporate news, Darden Restaurants saw its stock rise nearly 9% after announcing a delivery partnership with Uber, while Coursera jumped 8% following a buy rating from Bank of America, citing growth in revenue and margins. The market also awaited earnings reports from FedEx and homebuilder Lennar. All right, so that is that. Let's go on to our first article here, I guess our second article. This is a research report from First Trust titled, "And We're Off." This comes to us from Brian Westbury and Robert Stein, chief economist and deputy chief economist at First Trust. Basically, their take on the Fed rate cut yesterday. We'll go through their a summary of their text, and then I'll read through the statement from the Federal Reserve when we're done. All right. The Federal Reserve initiated its rate cutting cycle with a bold move, reducing rates by 0.5%, surpassing its earlier projection of a single 25 basis point cut in 2024. The Fed justified this more aggressive action by noting increased confidence in inflation moving towards its 2% target, sure, and a more balanced outlook between inflation and employment risks. This marked the first dissenting vote since 2005, with Fed Governor Michelle Bowman preferring a smaller 25 basis point cut, though all members expect further cuts by the end of the year. The updated economic projections show the Fed anticipates the unemployment rate to rise to 4.4% by the end of the year, up from 4% forecasted in June, and expects inflation, the PCE, to drop to 2.3%. The accelerated start to rate cuts suggests the Fed is front-loading its easing efforts, with additional 50 basis point cuts expected in 25 basis point increments before 2024 ends. Cuts for 2025 remain at 100 basis points. So we're going to go from 5.5 down to 4.5, and then another down to 3.5. So they're expecting that by the end of next year, we're going to be around 3.5, between 3.5%. While expectations for 2026 were scaled back to 50 basis points. So we're down to 3. Okay. If you say so. Fed Chair Jerome Powell downplayed concerns over the slowing labor market, emphasizing the Fed's data-driven approach. However, the key indicator to watch is M2, money supply growth, which has slowly increased after a period of contraction. If M2 growth remains modest, the Fed could continue cutting rates. However, a sharp rise could ignite inflation concerns, potentially derailing the Fed's current strategy. All right, so let's get down here. All right, here's the text from the Federal Reserve statement. Recent indicators suggest that the economic activity has continued to expand at a solid pace. Job gains have slowed and the unemployment rate has moved up but remains low. Inflation has made further progress toward the committee's 2% objective but remains somewhat elevated by 25%, if that's what you mean. Where was I? The committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. The committee has gained greater confidence that inflation is moving sustainably towards 2% and judges that the risks of achieving the employment and inflation goals are roughly in balance. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. Yeah, getting down to, they think it's going to get down to 2. But what if it doesn't? What if it goes back up to 3? So then they're going to have to raise rates and look like, stand around with egg on their face. In light of the progress on inflation and the balance of risk, the committee decided to lower rates to the target range for the federal funds rate by 0.5 percentage point to 4.75% to 5%. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, although at a much slower pace than they were last year. The committee is strongly committed to supporting maximum employment, I'm sure they are, and returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee assessments will take into account a wide range of information, including readings on the labor market conditions, inflation pressures and inflation expectations, and financial and international developments. Okay, that's a lot of words that doesn't really say a whole lot. So it's amazing. All right, got another economic report. August existing home sales. This also is from First Trust. Mr. Bryce Gill put this together, so let's see what he had to say. Existing home sales continued their downward trend in August, nearing their slowest pace since the 2008 financial crisis, despite widespread anticipation of Fed rate cuts and a 100 basis point drop in 30-year fixed mortgage rates. Affordability improvements have not yet spurred a significant rebound in buying activity. However, the Fed's recent rate cut may eventually encourage more buyers to the market. Home prices are rising again, with the median price up 3.1% year over year. The luxury segment of the market has seen some activity, with sales of homes priced at $1 million and above increasing at 7.9%. While overall existing home sales declined by 4.2%, many homeowners remain reluctant to sell due to mortgage lock-in after securing lower rates prior to 2022. Inventory levels have increased by 22.7% over the past year, pushing the month's supply of homes to 4.2, the highest since May of 2020, though still below the 5.0 months considered a balanced market. Tight inventory is preventing a significant decline in home prices despite slow sales. In other economic news, we already talked about the jobless claims. All right, so that is that. So the home market is still a bit shaky. And one more article. I saw this on my, I guess on the homepage when I opened up my browser this morning. And I was like, what? This is titled, Dave Ramsey told a Ramsey Show caller it's possible to withdraw 8% in retirement, but Suze Orman has called even 4% very dangerous. Who's right? As much as I hate to agree with a woman every once in a while, she's right. I mean, well, let's read through the summary here and see what they have to say. But yeah, 8%, crazy. I mean, yeah, if you want to be eating cat food when you're 85, that's probably the way you want to do it. The long-standing 4% rule for retirement, which advises retirees to withdraw 4% of their annual savings, is being questioned by financial experts. Dave Ramsey, a prominent financial advisor, and I'm putting that in quotes, suggests retirees can safely withdraw 5 to 6%, even up to 10%, without depleting their savings, citing a potential for mutual funds to yield up to 12% annually. When? In like bull market runs? I mean, yeah, but what about the years that it's down 30%? Yeah. Ramsey dismisses the 4% rule as outdated and overly conservative, particularly for those with substantial portfolio. Well, yeah, if someone's got $20 million, I mean, they can spend as much as they want if they live on, 70 grand a year. On the other hand, Suze Orman, another financial expert, advocates for a more cautious approach, recommending a withdrawal rate of just 3% annually for those retiring in their 60s. Orman highlights the risk of inflation and market volatility, warning that higher withdrawal rates could cause retirees to outlive their savings, especially those with smaller portfolios. The contrasting opinions underscore the importance of personalizing retirement portfolios. While Ramsey's advice may work for individuals with large portfolios, Orman's conservative approach may be suitable for those with less saved. Both agree that starting to save early is crucial for security in retirement. In the current economic climate, with inflation concerns and market volatility, retirees may also consider diversifying their investments into safer vehicles like CDs or real estate platforms to secure passive income and mitigate risk. And those have risks too. So you really got to be careful out there. I mean, I like Dave. I mean, he's got a good message, don't, live within your means and stuff. But again, this is a guy who filed bankruptcy multiple times. So he basically just took all his stupid mistakes and, put it into a, very generic boilerplate format that he sells books on and says, hey, do this, do that. And it's kind of like a workout program and diet program that, say someone wants to get jacked like, Arnold Schwarzenegger, well, maybe not Arnold, that's a bit much, but say you're in really good shape like Ryan Reynolds. I just saw the Deadpool movie recently. He's in really good shape. Say you want to get fit like him. Each person's a little bit different. Your metabolism's a little bit different, how you process proteins and everything else. So, what works for one guy may not necessarily work for another guy. And granted, he may be on some gear and, those have wealthy people who have doctors who, will prescribe them anything. So, but it's kind of the same thing with retirement planning. What works well for one guy may not work well for the next. So everything is really dependent upon lifestyle, what you want to spend, health, all those sorts of things, that are going to affect you in your later years. So anyways. All right. Well, that's everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. That's where you can go to get all your financial planning needs taken care of. So, all right. Well, I hope everyone has a wonderful evening, and I shall talk to all y'all again next time. Adios.